Which of the following single taxpayers may be able to claim the Earned Income Credit for 2024? None of them have any children. Mary, age 66, is a U.S. citizen, lived in the U.S. all year, and has AGI of $22,000. James, age 30, is a U.S. citizen, lived in Canada all year, and has AGI of $14,000. Cindy, age 26, is a U.S. citizen, lived in the U.S. all year, and has AGI of $17,200. Derek, age 65, is a U.S. citizen, lived in the U.S. for 9 months, and has AGI of $16,200. Think about it and maybe stand and stretch for a minute. Resume this video when you're ready to see the answer. Did you say that C was the correct answer? That's fantastic. Cindy, age 26, is a U.S. citizen, lived in the U.S. all year, and has AGI of $17,200 is correct because Cindy's AGI is below the AGI limit of $18,591 for a single taxpayer with no qualifying persons. Let's explain why these other answers are incorrect. The first answer, Mary, age 66, is a U.S. citizen, lived in the U.S. all year, and has AGI of $22,000 is incorrect. This is because Mary is over age 65 and her AGI is more than $18,591. The second answer here, James, age 30, is a U.S. citizen, lived in Canada all year, and has AGI of $14,000 is also incorrect. James did not live in the U.S. for at least 6 months. Here we have Derek, age 65, is a U.S. citizen, lived in the U.S. for 9 months, and has AGI of $16,200. This is incorrect because the rules state the taxpayer must be under age 65. Great work. You're well on your way. We have covered the rules for those taxpayers without a qualifying person. Now we will look at the rules for taxpayers with a qualifying person for the Earned Income Credit. Before we talk about the qualifying person for the Earned Income Credit, let me mention once again those blinders we talked about in earlier chapters. As a tax preparer, you must avoid distractions and losing focus. When we start talking about the requirements for the Earned Income Credit, you must focus on the specific requirements for the Earned Income Credit and let go of all the other tax requirements we have learned about previously. Let's put those blinders on and look at the requirements in more detail. To qualify for the Earned Income Credit with a qualifying person, taxpayers cannot be a qualifying child of another person and must have the following. A child who qualifies as an Earned Income Credit qualifying person by meeting the relationship, age, residency, and joint return tests of a qualifying child dependent. A child who is not claimed by more than one person for the Earned Income Credit. Taxpayer is not a qualifying person of another taxpayer for the Earned Income Credit. Adjusted gross income less than the limit based on their filing status and number of children they are claiming. The image on the left has the requirements for a qualifying child dependent. The image on the right lists the requirements for claiming the Earned Income Credit with a child who qualifies for the credit. We will take a closer look at each of these requirements and then come back to these images. Now we need to consider the relationship test. I have a little Q&A for you. To meet the relationship rule, how must the taxpayer's child be related to them? They must be a son, daughter, stepchild, eligible foster child, adopted child, or descendant of any of them. This includes grandchildren and great-grandchildren. They can also be a brother, sister, half-sister, stepbrother, stepsister, or a descendant of any of them. This includes nieces and nephews. Is a cousin included in the relationship test? Nope, not for the Earned Income Credit. What if the taxpayer says they treat the cousin as a child, niece, or nephew? The cousin still does not qualify the taxpayer to meet the relationship test. Is this the same relationship requirement for a qualifying child dependent? Yes, they have the same. What of the qualifying person's age? To meet the age rule, the taxpayer's child must be what age? They must be under the age of 19 at the end of the tax year and younger than the taxpayer or the taxpayer's spouse, if filing jointly. They must also be a full-time student under the age of 24 at the end of the tax year and younger than the taxpayer or spouse, if filing jointly. What type of child can be any age and qualify the taxpayer for the Earned Income Credit? One who is permanently and totally disabled, regardless of age. Are these the same age requirements for a qualifying child dependent? Yes, they have the same. What about residency? How does a child meet the residency rule? The taxpayer's child must have lived with the taxpayer in the United States for more than half of the tax year. Does this include Puerto Rico or U.S. territories? No, it does not include Puerto Rico or U.S. territories such as Guam. How many days would the taxpayer's child need to have lived in the United States to meet this test? 183 days. This is 365 days multiplied by 50%, which equals 182.5, but it must be more than half. For a leap year, which 2024 was, it would be 184 days, which is 366 days, multiplied by 50%, which equals 183, but it must be more than half. Is this the same residency requirement for a qualifying child dependent? Not quite. For the Earned Income Credit, the child must live with the taxpayer more than 6 months in the United States. For dependency, the child must only live with the taxpayer more than half the year. It does not have to be in the United States. What about military personnel stationed outside the United States? If they are on extended active duty, they are considered to live in the United States during that duty period. Is there an exception to this rule for divorced, separated, or unmarried parents, as for a qualifying child dependency? No, for the Earned Income Credit, the child must live with the taxpayer in the U.S. for more than half the year. Only the custodial parent can claim the Earned Income Credit. It does not travel to the non-custodial parent. Now it's time for a check for understanding question. With the limited information provided, which of the following taxpayers is most likely to be able to claim the Earned Income Credit for the dependent listed? Sally, grandparent of James. Bella, non-custodial parent of Ralph. Stacy, cousin of Missy. Joseph, who is claiming Samantha according to a divorce agreement. Pause to think about it. Drink some water. Resume when you are ready. If you think the answer is the first one here, you are correct. Nice work. Sally, grandparent of James, is correct because a grandparent could possibly claim a grandchild for the Earned Income Credit if all the other requirements are met. Let's discuss why the others are incorrect. Bella, non-custodial parent of Ralph, is incorrect. This is because the custodial parent could possibly claim their child for the Earned Income Credit. In fact, even if the custodial parent gave up the dependent exemption to the non-custodial parent, the custodial parent could still claim the child for the Earned Income Credit. A non-custodial parent will never be able to claim the Earned Income Credit, regardless of whether they are allowed to claim the dependency exemption. This is because the qualifying person must live with the taxpayer more than half the year. There are no exceptions. The non-custodial parent does not have the child more than half the year. Stacy, cousin of Missy, is incorrect because an aunt or uncle could possibly claim a niece or nephew for the Earned Income Credit if all the other requirements are met. The Earned Income Credit cannot be claimed for a dependent who is a cousin. Joseph, who is claiming Samantha according to a divorce agreement, is incorrect because a divorce decree or agreement does not dictate when a taxpayer may claim the Earned Income Credit. More information would be needed. Is Joseph also the custodial parent, or is he a non-custodial parent? Thanks for your participation. Fantastic job. Let's look at the joint return test. The taxpayer's qualifying person cannot file a joint return unless it is just to claim a refund of withholding the taxpayer paid. If a taxpayer's qualifying person is married, the taxpayer must be able to claim dependency for that qualifying person unless it travels to the non-custodial parent due to the divorced, separated, or unmarried parent exception. For example, a taxpayer supported his 18-year-old daughter, and she lived with her father while her husband was deployed in the armed forces. The son-in-law earned $28,000 for the year. The couple files a joint return. Because the daughter and her husband file a joint return, she isn't a qualifying person. Is this the same joint return requirement for a qualifying child dependent? Yes, it is the same. Let's change up the situation. What happens if a qualifying person does qualify more than one taxpayer for the Earned Income Credit? Let's first talk about the divorced, separated, or unmarried parent rules. All dependent-related benefits get claimed on one person's tax return, unless the rules for divorced, separated, or unmarried parent rules apply, as discussed in the Dependent-Related Filing Statuses chapter. Contrary to popular belief, it is not up to the parents to decide who will claim the Earned Income Credit year after year. Remember, only the custodial parent can claim the Earned Income Credit for a child who qualifies. Let's look at each of these tax benefits and decide if the benefit can travel to the non-custodial taxpayer. Pause to think about this for a minute, then resume when ready. The answers are also on the next slide. You may hear a taxpayer state, "My divorce decree states I get to claim Amanda this year as a dependent, so I will get the Earned Income Credit as well." Is the taxpayer making an accurate statement? Not necessarily. It depends. For this tax year, is the taxpayer the custodial or non-custodial parent? If they are the IRS-defined non-custodial parent, then the statement is not true, and the reasoning will need to be explained to the taxpayer. Can a taxpayer be an earned income credit qualifying person themselves and have a qualifying person for earned income credit? No. Any taxpayer or their spouse, if filing a joint return, who is a qualifying person of another taxpayer, cannot claim the earned income credit. This is true even if the other person chooses not to claim the taxpayer. Is there a time when a qualifying person can claim the earned income credit? Yes, there are two exceptions to a qualifying person claiming the earned income credit. If the individual's parent or another person for whom the individual is defined as a qualifying child is not required to file an income tax return and either does not file an income tax return or files an income tax return solely to obtain a refund of withheld income taxes. Now, what happens if a parent and grandparent happen to both claim the same qualifying person for the earned income credit? What have you learned about so far that would help in a situation like that? Tiebreaker rules. The earned income credit rules specifically state the same qualifying person cannot be used by more than one person to claim the earned income credit. In other words, only one taxpayer gets the benefits associated with the qualifying person. Two qualifying taxpayers cannot split the benefits between themselves. For example, a qualifying person who lives with a parent and a grandparent and qualifies both for the qualifying child dependency and the earned income credit. If the grandparent's AGI is more than the parent's AGI, they can decide who will claim the qualifying person on their tax return. Can the parent and grandparent split the dependent by allowing one to claim the qualifying person as a dependent for the child tax credit and the other to claim the qualifying person for earned income credit? No. Remember, the only time any benefits can be split is when using the divorced, separated, or unmarried parent rules, and even those rules do not change who can claim the earned income credit. If more than one taxpayer claims the credit with respect to the same qualifying person, the IRS will decide who will receive the credit based on who can claim the qualifying child dependent according to the tiebreaker rules. Families today live in many different types of households, sometimes with extended family members living there also. As a tax preparer, what must you do to be confident you are exercising due diligence regarding the tiebreaker rules? Continue to ask open-ended questions, testing the tiebreaker rules until you feel confident the taxpayer qualifies to claim the dependent. Earned income credit is only available for which parent? The custodial parent according to the IRS definition. The waiver of the exemption to the non-custodial parent under the divorced, separated, or unmarried parent rules does not apply for earned income credit purposes. Only the custodial parent may claim the earned income credit with respect to the child. This is also true of the head of household status and the child and dependent care credit. Now that we've come full circle with the qualifying person rules for the earned income credit, let's look at some familiar images again. What test for a qualifying child dependent is not a test for a qualifying person for the earned income credit? If you're thinking support, you are correct. What does this mean for the taxpayer? The taxpayer may not be able to claim a child as a qualifying child dependent if the child provides more than half of their own support. But that same child will qualify the taxpayer for the earned income credit if all the other requirements are met. Can a taxpayer who provided 0% support to their child claim the child for the earned income credit? Yes, if all the other tests were met. Let's think about this for a moment. If the parent provided 0% support, which other earned income credit requirement would you think they may not pass? They may have no earned income if they are not providing any support. Hopefully, you are starting to see why questioning the taxpayer becomes important. The taxpayer may pass one requirement and fail another requirement at the same time. As a tax preparer, you will not know until you ask the questions and then ask the appropriate follow-up questions. It's time for another check for understanding question. Which of the following benefits can travel to a non-custodial parent if the divorced, separated, or unmarried parent rules are allowed? Head of household filing status, earned income credit, dependent care credit, child tax credit. Pause and think before moving on to the answer. Did you guess the last one here? You genius. Child tax credit is correct because the non-custodial parent, when using the divorced, separated, or unmarried parent rules, may claim the child tax credit, additional child tax credit, and other dependent credit. Let's dive into the other responses to see why those are incorrect. Head of household filing status is incorrect because the head of household filing status requires the potential dependent to live with the taxpayer more than half the year. Only the custodial parent may use the head of household filing status. Earned income credit is incorrect because the earned income credit requires the child to live with the taxpayer in the United States more than half the year. Only the custodial parent may claim the earned income credit if all the other requirements are met. Dependent care credit is incorrect because the dependent care credit is one of the credits that cannot travel to the non-custodial parent. Great work. Remember the old woman who lived in a shoe? She had so many children she didn't know what to do. The first step in claiming the earned income credit for eligible taxpayers is to complete Schedule EIC for those taxpayers with one or more qualifying persons. Schedule EIC requires information about the qualifying person or persons. The old lady who lived in a shoe had 5 children. Where are the other 2 children listed for the earned income credit? If a taxpayer has more than 3 qualifying persons, information is only entered for 3 of them. What if the old lady in the shoe also had her sister living with her all year? What potential benefit could the sister have? I'll give you a hint. What if the sister's AGI is more than the AGI for the old lady in the shoe? The answer is if the other 2 children are qualifying persons of the sister, their aunt. She could claim them for the earned income credit if her AGI was higher than the parent's and the parent wasn't claiming them for any benefits. So the parent could claim 3 children and the aunt could claim the other 2. Do taxpayers who do not have a qualifying person but are eligible for the credit complete this form? No. This only must be filled out for taxpayers with a qualifying persons. The next step is to complete the earned income credit worksheets. What tables do we use when completing the earned income credit worksheets? We use the earned income credit tables, not the tax tables. Where can you find the earned income credit tables? Publication 596, Earned Income Credit, EIC, starting on page 28, or the Form 1040 instructions, starting on page 46. Now let's look at Exercise 5.1. Exercise 5.1 asks you if each taxpayer in the scenario qualifies for the earned income credit. We'll use Publication 596 to determine how much credit they will receive. Let's look at the first one. Ronald, age 28, single, is not disabled, and has no dependents. Ronald's earned income and AGI was $13,452, all from wages. He had no other income. He is a U.S. citizen, lived in the United States all year, and has a valid Social Security number that allows him to work. He did not have any foreign income and will not file Form 2555. Ronald qualifies for the earned income credit. He has a valid SSN, is a U.S. citizen, has no foreign income, no investment income, is over the age of 25 and under the age of 65, is not a dependent or an earned income credit qualifying person of another taxpayer, lived in the U.S. more than half the year, and he is under the threshold for a taxpayer without a qualifying child. With his $13,452 in earned income, you would receive $391 in earned income credit. Now on to Exercise 5.2. Here is Timothy Barclay. He is single, earned $10,391 working during the year. He also received interest from a CD that his grandfather gave to him. His bank reported $25 of interest for the year. Timothy had no other income and no adjustments to income. No one can claim him as a dependent. He is a U.S. citizen, lived in the United States all year, and has a valid Social Security number that allows him to work. Timothy had no dependents. He has no foreign income and will not file Form 2555. Here is Timothy's 2024 EIC Worksheet B, line 4A. His earned income from line 1Z of Form 1040 is $10,391. Here is Timothy's 2024 Earned Income Credit Worksheet A, Earned Income Credit, line 27. We need to find the earned income credit amount for his earned income, which is based on $10,391. $629 goes in box 2. The instructions tell us to enter the amount from Form 1040, line 11 on line 3 of this worksheet. Line 11 of Form 1040 is the adjusted gross income. Timothy had $25 of interest income, so $10,391 plus $25 is $10,416. Looking at the earned income credit tables again, we see that the credit is $625, so we enter that on line 5. On line 6, we enter the smaller of line 2 and line 5. Timothy's earned income credit is $625. Let's walk through Carolyn Fox next. Carolyn Fox, age 37, files as head of household. She earned $22,811 working during the year. She received $13 of interest from her checking account. Carolyn also received $184 of ordinary dividends from stock. She had no qualified dividends or capital gains distributions reported on her Form 1099 DIV. She had no other income and no adjustments to her income. Carolyn has one dependent daughter, Myra, age 7, who lived with her all year long. No one else lived in their home during the year. Carolyn and Myra are both U.S. citizens, lived in the U.S. all year long, and have valid Social Security numbers that allow them to work. Carolyn had no foreign income and will not file Form 2555. Here is Carolyn's 2024 EIC Worksheet B, line 4A. Her earned income from line 1Z of Form 1040 is $22,811. Here is Carolyn's 2024 EIC Worksheet A, earned income credit, line 27. We need to find the earned income credit amount for the earned income, which is based on $22,811. $4,196 goes in box 2. The instructions tell us to enter the amount from Form 1040, line 11 on line 3 of this worksheet. Line 11 of Form 1040 is the adjusted gross income. Carolyn received $13 of interest from her checking account and $184 of ordinary dividends, so $22,811 plus $13 plus $184 is $23,008. Looking at the earned income credit tables again, we see that the credit is $4,164, so we enter that on line 5. On line 6, we enter the smaller of line 2 and line 5. Carolyn's earned income credit is $4,164. Now let's do the next check for understanding question. Joe, 27, is single with no qualifying person. What is the maximum AGI he could have to still qualify for the earned income credit? $18,590, $18,591, $25,510, $25,511. Pause to allow yourself time to look this up. Resume when you are ready. If you got $18,590, you are correct. A single taxpayer must have AGI less than the threshold of $18,591. Let's see why these other answers are incorrect. $18,591 is incorrect because a single taxpayer must have AGI less than the threshold of $18,591. Language is very important regarding the tax code. $25,510 is incorrect because this is the maximum AGI for a married couple without a qualifying person who file a joint tax return. $25,511 is incorrect because this is the AGI threshold for a married couple without a qualifying person who filed a joint tax return. Married taxpayers must have AGI less than the threshold of $25,511. Work, you're fabulous. When determining if the taxpayer qualifies for the earned income credit as a tax preparer, remember you have due diligence requirements.